Growth stocks are a type of stock that typically experience above-average price appreciation and earnings growth. Growth stocks tend to be more volatile than other types of stocks, but also offer the potential for greater returns. Many investors choose to add growth stocks to their portfolios to achieve higher returns over time. In this video, we discuss growth stocks investing. There are a few things that make a stock a growth stock. First, growth stocks typically have high price-to-earnings (PE) ratios. This means that they are relatively expensive compared to other stocks. Second, growth stocks often have high rates of revenue and earnings growth. Finally, growth stocks tend to be more volatile than other types of stocks, meaning that they can go up or down in value more rapidly. There are several reasons why investors might choose to invest in growth stocks. First, growth stocks have the potential to generate high returns. Over time, a portfolio of growth stocks has the potential to outperform the market as a whole. Growth stocks offer diversification benefits. Including growth stocks in your portfolio can offset some of the risks associated with other asset classes, such as bonds or cash. Despite their potential benefits, a few risks are associated with investing in growth stocks. Investors should prioritize companies that have a competitive advantage over their rivals. This could be in the form of a unique product, a strong brand, or a lower cost structure. Companies with competitive advantages are more likely to continue growing at above-average rates, which is essential for growth stocks. In addition, investors should look for companies that have a history of consistently delivering strong financial results. Companies that have consistently grown earnings and revenue are more likely to continue doing so in the future. Furthermore, these companies are more likely to weather economic downturns better than their less successful counterparts. Finally, investors should be aware of the valuation risks associated with growth stocks. Growth stocks tend to trade at higher valuations than other types of stocks. Investors should identify the trends that are driving growth in specific industries. This will help them find the companies that are best positioned to benefit from these trends. For example, the rise of e-commerce has been a major driver of growth for many retail companies. Similarly, the popularity of streaming services has been a tailwind for many media companies. Once investors have identified the trends driving growth, they can research specific companies to find those that are best positioned to benefit from these trends. In addition to identifying industry trends, investors should also look for companies that have strong fundamentals. These tend to be more resilient and have a higher likelihood of continuing to grow even during tough economic times. Growth stocks and value stocks are two of the main types of stocks that investors can choose from. Growth stocks are those that are expected to grow at a faster rate than the overall market. Value stocks, on the other hand, are those that are considered to be undervalued by the market. There are a few key differences between growth stocks and value stocks. First, growth stocks tend to be more expensive than value stocks. This is because investors are willing to pay more for a stock that is expected to grow at a fast pace. Second, growth stocks tend to be more volatile than value stocks. This means that they can go up or down in value more rapidly. Finally, growth stocks offer the potential for higher returns but also come with higher risks. Some examples of growth stocks include Amazon, Facebook, and Google. These companies have all grown at a rapid pace in recent years and are expected to continue to do so. While there are many other examples of growth stocks, these three are some of the most well-known. Investors should remember that growth stocks come with higher risks. They should only invest in these types of stocks if they are willing to take on additional risk. Furthermore, investors should carefully research any company before investing. This will help them understand the risks and potential rewards associated with each stock. Growth stocks tend to do well during periods of economic expansion. This is because these companies are typically able to grow at a faster rate than the overall economy. However, growth stocks can also be volatile and may decline sharply during periods of economic recession. For this reason, it is important for investors to carefully consider the time frame in which they plan to invest. Final thoughts: growth stocks can offer investors the potential for high returns. However, they also come with higher risks. Before investing in any stock, investors should carefully research the company and understand the risks involved. Thanks for watching. Please like and subscribe for more related videos.